Another solid performance today for gold. The precious metal climbed to another record high this morning, as high as $1,119 a troy ounce. Demand for gold has been rising as the dollar declines. Today, the greenback is lower for a third day against a basket of 6 currencies. Frank McGhee is head metals trader at Integrated Brokerage Services. He joins us now from Chicago. Frank, welcome to Bloomberg News. Always good to talk to you.
My pleasure to be here, Mark.
Frank, what's going on?
Well, you're seeing a true monetary rebalancing, especially among the central banks. With this purchase by the Indian Central Bank a week or so ago, you're now seeing net purchases by the central banks. They've turned from net sellers, which they have historically been over the last 15 to 20 years, to net buyers. This is really almost a reallocation of significant portions of their reserves, and it ultimately is going to continue to drive this market forward.
And Frank, you mentioned India, their central bank last month buying 200 metric tons of gold from the IMF. Did that start a ripple effect?
It certainly brought back to the forefront the concept that the central bankers will buy gold and add gold to their reserves. It's almost like a reallocation of any portfolio, and in many cases you're seeing gold purchases against other currencies rather than the dollar. And so to that extent, you have gold appreciating against almost all major currencies right now. It's not just a dollar play.
A lot of central banks are showing interest in gold, correct?
I think you're going to continue to see that happening and going forward, especially if you have the continued talk of potentially politicizing the Fed in the United States, which will make the dollar monetary policy less secure, and as you continue to have the amount of liquidity that's floating around the system still continuing to not really even start having the effect of that there yet.
Yeah, and Frank, you mentioned the Federal Reserve. What happens to gold if the Fed keeps rates near zero?
We end up going up. This is a monetary activity. I know a lot of people will come out and say, well, this is an inflationary activity. But at the end of the day, inflation is a result of the monetary policy, not because of the monetary policy. And by that I mean it's the monetary policy that sets the ground for future inflation. That's what we're seeing happen here. We're seeing a continued expectation of declines in dollars as well as many other currencies.
Frank, talk to me about, I guess, let's go back like maybe to the spring, maybe to April or May. Could you see gold reaching this level back then? Was that something that was on your radar screen?
Oh, well, go back 4 or 5 years. I mean, when we were down in the 200 and 300 range, we were one of the first entities and groups to be calling for gold over 1,000. We were originally calling this first move to be about $11.90 by the end of the year. Looks very realistic. If we only get within $30 or $40, we'll be quite happy with it. But the amount of overall interest says that we're going to continue higher. We're going to have volatility. We won't go there straight. We'll have some very vicious breaks in this market. Ultimately, they'll all be buying opportunities.
Can we talk about the dollar for a second? We did an interview here at Bloomberg today, and one of our guests was saying that the dollar is going to continue to be the victim of the carry trade. Do you agree with that assessment?
Well, it's certainly for those people who can still access the credit markets on their balance sheets and take advantage of it, given that the dollar and the perceived interest rates that we'll have in the United States are going to be lower than most of the rest of the developed world, and certainly most of the developing world for an extended period, you'll be able to see people borrow in dollars and get a higher return someplace else. So yes, the biggest aspect, though, that I think is going to occur in a pure Fed central bank watching element is that the European bloc, the Asian bloc will be raising their rates sooner than we will and faster than we will.
Well, speaking of the Asian bloc, China stepping in and saying today that it wasn't going to step in and buy gold at these prices.
Well, I think to a large extent the Chinese are probably some of the most astute gold traders that the world has ultimately ever seen. They very rarely tell you ahead of time what they're doing. They've been acquiring for a long time, and I would expect to see them continue.
Well, we actually have word. I was emailing our commodities reporter, Michael Whitney, and he tells me that a former high-ranking official from China's State Administration of Foreign Exchange stated China should wait until prices fall to $800 an ounce.
Well, ultimately, if you are a large acquirer or a large distributor of metal, as China certainly is, you will try and push the market to a place that's favorable for you to do something.
Right.
And so they can try and talk a market wherever it wants to go. Ultimately, it's going to go where it's going to go.
And Frank, in about 15 seconds, where's gold going to be at the end of the year?
Close to 1,200.
Frank McGhee of Integrated Brokerage Services joining us from Chicago. Frank, as always, thanks for your expertise. We appreciate it.
My pleasure.